I do want to clarify though, like we're not lending to tax deed investors. The way we structure it is it's a profit share structure where the fund we own all the tax deeds that we're partnering with local folks on, and that's a very big difference, right? From a I guess Darren, you're in the insurance from a risk standpoint, right? As we don't all the properties that we are utilizing, right, in collateralizing our investment, we don't have to go through a foreclosure process if things go awry. We already own the property, and so because of that, every investor that invests in the fund is also collateralized by those properties itself, and so it's a pretty, I guess a little more secure than a mortgage or a lending scenario.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CREPN Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Brian Seidensticker.
There you
go. Thank you. Brian Seidensticker. He founded Tax Sale Resources, TSR, in 2010. And in 2017, Brian partnered with software developer SDA Solutions, a comprehensive workflow management system. And in 2020, Brian launched Mount North Capital, a 506c fund, providing capital to tax deed investors. And in just a minute, we're going to speak with Brian Seidensticker about Delinquent Tax Investing. But first, a quick reminder, if you like our show, CREPN Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We'd love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Brian Seidensticker. Welcome to CREPN Radio.
Well, thanks, Darren. Thanks for having me. I'm excited.
Well, I'm looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
A little bit. Well, you're probably gonna have to cut me short a few times, Darren. I'm not really good at short and sweet, but I did not really grow up with aspirations of being a tax sale guru or tax sale investor or data provider. I was actually an aerospace engineer in what I call my previous life, working on missile defense programs for the private contractor, doing some pretty fun things. At least it sounds really cool. Most people say it sounds really cool. I had an epiphany coming back from a vacation, a longer vacation, and realized like nothing had really changed while I was gone, even though, on the day-to-day basis, I felt like I was on getting stuff done, but ultimately I was on a hamster wheel. And I term it like it was roughly 2 years of banging my head against the wall for 2 minutes of cool is a good description of my previous life or job. I got into tax sales really on the wrong side, and I got a notice on one of the properties that I was fixing flipping as a side gig in 2007, 2008. It was really the start of the crash, right? And as weird, Montana has some weird statutes where every investor that potentially is going to buy a tax lien on your property has to send you a certified letter. So I got a bunch of these certified letters in the mail with varying language, but all of them basically saying, hey, you could lose your house due to your unpaid taxes. And That made me do a lot of research into what this whole taxing thing is. Eventually found that it is a real industry that not a whole lot of people know about. It's roughly the size in revenue as the NBA. It's about $9 to $10 billion a year that is transacted through delinquent taxes, but nobody knew anything about it. So I guess long story short, I pivoted at the time, got out of flipping, started buying tax liens because I thought this was the next cool thing. Um, and nothing existed at the time that basically tells you now, right, when, where, and what properties are in these auctions. And like Taxable Resources is one of those resources, but there's several out there today. But at that time, nothing like that existed. And so actually started building an internal tool, and then was suggested at a conference to make that tool public and maybe cover some of my overhead. And that that's really how Taxable Resources was born. That was the first time that I thought about it as a product and not just a tool. And within a couple of years, the revenue we were getting from the sale of that tool, right, it outweighed what I was making on the fund, if you want to call it a fund at the time. It was not that big. And so I abandoned buying tax liens directly at the time, and dove into the software data analytics world, and really was a provider of those things for the institutional level investor, folks that are buying liens at a large scale, like $5 million or more on an annual basis. And we did that model for 7-8 years before we eventually branched out, built a more comprehensive underwriting platform that's a lot more easy to use. Think of like a Zillow style platform for just tax sale properties, and then built a portfolio management tool, and then dove into the tax deed space, and really diving in the tax deed space. And I'm sure listeners now are going, what do you mean tax liens, tax deeds? What are you talking about? We can dive into some of that if you want, Darren, but tax deeds is essentially real estate investors, and real estate investors look at investments very, very different than tax lien investors, which are closer to like note investors, right? Mortgage investor type folks. And we realized also that the investors on the tax deed side are usually capital limited to some degree. And at the time, I didn't know why, right? Eventually figured out it was because you really can't get title insurance on tax deeds, definitely not from the county. And so you can't get bank financing, for a period of time. And so you literally have to go to the auctions with cash. And most people don't have, millions of dollars laying around in cash. And so it really limits those folks. And that's what led us eventually to create Mountain North Capital, which is a fund that we operate. And so we bring in capital from folks that maybe understand what we're doing, but don't want to participate. They just want a decent return. And we provide the capital to the tax deed investors that need it in order to do what they're already doing, just on a larger scale. That's really what's brought us to today. We've been doing all of those things for the last 5 years. Mountain North is on its third iteration of a fund, and definitely see a lot of growth on that side. And it's been exciting. Not always been fun, but mostly been fun, and definitely learned a lot along the way.
Well, that's fascinating. I mean, from a notice you received to a full-grown tool business that is, I mean, that's kind of a neat story there. I appreciate you sharing that with us.
It's been a journey.
Yeah, I think one of the things that I think would be appropriate to make sure we make the clarification on, you mentioned the difference between a deed and a lien. And I'm curious, is that an option of the borrower, or is that an option of the lender, or is that something that's driven more by the jurisdiction the property's in, or how is that different?
Yeah, those three options, definitely jurisdiction, state statute driven. And so some states offer only tax liens, some states offer only tax deeds at auction. Many states and more states are starting to offer both. And it just kind of to describe how the process works a little bit. It's everything, devil's in the details, and it's more complicated than this. But essentially, if a property owner doesn't pay their property taxes, counties, right, are trying to balance their budget. They need that cash, right? And so a lot of that cash is actually driven by the threat of selling a tax lien. So people get notices in the mail, and roughly 70-80% of the total delinquencies in taxes are remedied way before the sale ever happens. But those that do make it to the sale, the county just wants their cash. So what typically happens is they turn around and sell a lien. So they put a lien on the property, right? And that lien carries penalties and interest and that sort of thing. And so if the property owner comes back and pays their taxes, and most do later, right, then they don't just pay the taxes that were due, they got to pay more than that, right? Now, the more than that amount, whatever that is what gets paid to the investor that buys the lien. And so it's kind of a great marriage, if you will, of the county needs the money, so the investor comes in and says, hey, so you can balance your budget, pay the firemen, pay the police, pave the roads, here's your money, right? And then in exchange, the investor earns the return on that delinquency if and when the property owner pays their taxes. And 98% do pay their taxes. And that's the lien side of it. Now, at that point, I call them a micro mortgage because I think most people are familiar with how a mortgage works, right? And if you don't pay your mortgage, eventually it can go through a foreclosure, right? And it can end up losing the ownership of your house through a mortgage foreclosure. And a tax deed scenario is very similar. So if the property owner continues to not pay their taxes, eventually the tax lien holder can start a tax deed process in most states. And that process varies. Usually it's, many states it's judicial, and it will culminate in the sale of that property, just like a mortgage foreclosure sale. And the sale of that property is what I call the tax deed. Not every state calls it that. That's just a catch-all bucket because there's many different terms out there. But the difference is in a lien, you're buying an interest in the property, just like a mortgage. You have no rights to the property itself. You just have an interest in the property, meaning if it sells, you have the right to get paid if it transacts, right? A deed, on the other hand, you're buying the property itself. And so that's why I mentioned the mindset and the goals of tax lien buyers is so different than tax deed buyers, because you have kind of passive investing folks looking for the note. It's like, hey, I buy a note, I'll get my interest. You don't get paid on a monthly basis, but when it does pay off, and most do, you'll get that money back plus interest, and you don't have to do a whole lot. Deeds is very, hands-on. You bought the property, so just like your home, you got to take care of all the things like you would typically at your home, and it's just a much more complicated, process. So, anyway, there's probably questions that come out of that, but I'm not real sure. I'm not real good at short answers, Darren.
No, it's all good. And I think that the first thought I had, just for a clarification, so the borrower doesn't pay their taxes. That's the first thing, because again, that's what's going to trigger the county to put the lien on it. And what I wanted to just make sure I understood: does the county then assess the penalties for non-payment that are essentially interest that then get passed on to the investor that buys the tax lien for paying that when they pay the tax to the county, they get that interest and penalties transfers to the buyer?
Correct.
Okay.
Now, I'll say that in general, correct, right? Every state has a little
Right.
different process, and there's some states where it's not county driven, it's investor driven relationship. But the vast majority is that the county is the one doing all of that, right? And the county is just passing on that return, if you will, to the investor.
Got it. All right. So then an investor buys a tax lien. The original borrower does not make it good, does not pay off the debt, does not pay the lien and the interest taxes, and then at some point the buyer of that lien has the opportunity then to foreclose. Is that essentially what happens, or?
Correct. Yeah. So again, the time length varies by state, but most of them are multi-years, right? And so if you buy that, the tax lien in, say 2020, just for sake of example, in many states, you can't actually start a foreclosure for 2 or 3 years. And so it's 2022, 2023. And the homeowner has the right, should, and very high percentage of them will pay their taxes in that time frame. And so as soon as they pay their taxes, the investor gets paid back. If they don't, right, then there's a time frame where the investor can start it. Then in many areas they don't have to, and then in most states there's also like an end. And so if they don't, right, within, I'll use Florida for example, investors can start the tax deed process, right, the foreclosure, after 22 months, roughly 2 years, but they have to do it by 7 years. And if they don't, then their lien goes invalid, meaning they can never collect on it. And so there's definitely restrictions, and the value to that lien isn't in perpetuity.
Got it. Got it. Okay, so interesting. We've distinguished between the lien and the deed. You have or your fund is primarily focused on working with people that are buying deeds. Is that correct?
Correct. Yep.
Okay. And so the I guess the question then is what types of properties are we talking about? Are these uh, single family? Are these bare ground? Or they can you describe kind of the range of properties?
Well, yeah, the short answer is everything, because anything that doesn't, that has delinquent taxes can end up there. I mean, the vast majority is vacant land and residential, but certainly see commercial, multifamily, crazy things like right of ways, mailboxes, all these weird chunks of land, that the county puts boundaries around, can end up in that process. So roadways, sometimes, sidewalks. And so not every property is a valuable property at the end of the day. It definitely varies widely, but it's typically vacant land and single family residential.
Got it. So your tool, uh, what is it? Does it scrape county records, or how where do you start to get your data?
The data itself isn't anything overly special. It's county assessors data with a few other data, sets worked in, like we have environmental data, flood data, that kind of stuff, and recorders data in there. But basically combines all of that, and only really just trying to provide investors of both on both sides with enough information in order to be able to decide which ones are worth buying and which ones are not, right? I mentioned the weird, parcel shapes, and I use this example regularly. Like there are counties out there, and not every state does, but there's counties out there where, for some reason there is a mailbox on its own parcel number, right? And nobody's paid taxes on that mailbox. And I think one of the biggest pitfalls that new investors in the space run into is they have this assumption like, oh, there's value in everything, right? And I'll buy the lien on that, without really doing much research on it. And lo and behold, they bought the lien on a mailbox, and then 2 years later, they realize nobody's paying the taxes on it, and then they go to foreclose, and they realize, oh, wait a minute, this is only a 4 square foot chunk, and it's my mailbox. Like, what do I do with that? Really, there's no value to that, and so that was a bad investment, right, at the end of the day. And that's the biggest thing that we're trying to enable folks to do, is to figure out which ones are worth buying and which ones are not. And the definition of worth buying varies immensely, right, from one investor to a next. But we try to give them the information to make that decision.
Got it. So another thought that occurs to me is that I'm assuming the cost of a lien is substantially less than a cost of a deed. Am I correct?
Correct. Yeah. I mean, lien, think of it as, roughly whatever the taxes on your
Right.
house would be, right? And so that
Right.
varies state to state, but you're talking, 5% of the value of a house, on the high end, maybe. And then, on the deed side, it's competitive just like any other auction. A lot of them are held just the same way people imagine, right? Paddles, right? Bidding up, and they go for, not 5%. You're talking 60, 70, 80, 90. Some areas it's 100% of market value where those properties are sold at. So yeah, there's a significant difference between the two.
Got it. And that would explain exactly why the buyer may need some funds, which is where you come in. Um, so the opportunity with your I mean, you got both the fund and then you've got the tool. So if I'm listening to this and I've got some money to invest, but I'm not really interested in doing the buying deeds, et cetera, is that something that do you seek investors for your fund?
We do. So it's a 506C, which basically means it's open to accredited investors. We are in, I'll say, constant capital raise mode. We were 28 million dollars, placed at the moment. We think there's a significant growth potential there, and so we're in constant capital raise. But it's not a stock like you'd see on a stock exchange. You can't just go buy one share. You do have to be accredited, and as long as you meet those requirements, then you can invest in the fund.
Got it. And with that, is there a minimum investment?
There is 50,000 is current minimum investment. But if you are accredited and would like to participate in the space, essentially you can do it through that mechanism instead of jumping in and doing it yourself.
Got it. And in that, as a fund, in the fact that you're lending money to buyers of deeds, what's the typical life expectancy of a fund, and when would, how long would somebody essentially be invested in a fund?
So the fund itself is evergreen. So it's not the way we've structured it is the fund itself is evergreen. The investments is actually a note structure. It's through an intercredit agreement, basically states all of the investors are on the level playing ground. And right now we have 2-year notes, and so it's a 2-year investment cycle, right, is how it works today. I do want to clarify though, like we're not lending to tax deed investors. The way we structure it is it's a profit share structure where the fund, we own all the tax deeds that we're partnering with local folks on. And that's a very big difference, right? From a I guess, Darren, you're in the insurance, from a risk standpoint, right? As we don't, all the properties that we are utilizing, right, in collateralizing our investment, we don't have to go through a foreclosure process if things go awry. We already own the property, and so because of that, every investor that invests in the fund is also collateralized by those properties itself, and so it's a pretty, I guess, a little more secure than a mortgage or a lending scenario.
Oh yeah, you've eliminated all the possible Mickey Mouse of having to foreclose or chase somebody, to try and get paid. I mean, if you're not getting paid, you have the full leverage to sell the property yourself. So that is, I think that's almost a necessity in that, or not. It's not a necessity, but it certainly simplifies the what if things don't work out. How do you solve? So that's great. Um, so okay, we talked about the opportunity to invest in the fund. What if somebody is knows of a property that's you know it's going up for auction and they'd like to acquire it? How do they uh, access your tools, the funds, et cetera? What's the process for something like that?
Yes, so you can certainly sign up as what we call a profit share partner. On that side, there's certainly several communications and an onboarding cycle in order to make that happen. I mean, to start it, right, you go to our website, taxsaleresources.com, and reach out, whether it's via email, make a phone call and just say, hey, I'd like to talk to somebody about the profit share structure, and they'll get you in contact with the right person on our team to walk you through that. We do have requirements that we're not a coach, we're not an educator in the space. That's not our role. There's many educators out there. A lot of them are good, some of them aren't as good. Um, but we're not going to be able to like teach you how to do this. That's not our thing. But once you kind of know what you're doing, and so one of the major requirements is that they've bought a tax deed previously, right? They've gone through that education, they've gone through that I say crossing that chasm. It's a big chasm from knowing everything and then actually doing it, right? But once you've actually done it, then you would qualify for working with us. And so for the folks that are listening that maybe say, hey, this is interesting, don't necessarily seek us out, right? If you don't know what you're doing yet, right? Is you can go to Google or any more, any of the AI tools out there and ask for tax sale and educators out there, and I'm sure you'll get a list of folks and start there. Right now, once you know what you're doing, or if you already know what you're doing and you want to utilize our program, then definitely reach out to us.
Got it. And in the program, you talked about I mean, I guess the software, the tool, and the fund. Are they uh, two? Do they work together, or can you access the tool and then when you find a property, uh, get the funding?
Yeah, we do have a program that puts the two together, right? You can use just the tool, you can use just the funding, right? We have a package we call Accelerator Program because we felt, we really could enable folks more if we put all of these things in one offering. And that's what the Accelerator Program, and it's basically we teach you how to optimize using the tool, right? Optimize using the data that we have. We track results of sales. We have a really good idea of what stuff is selling where. And usually one of the biggest um, comments I get from newer investors coming in the program is they're frustrated because they went through all the education, they went to their first sale and got absolutely blown out of the water, right? And their first sale was probably one of the online auctions in a popular area, thinking they're going to get a great deal. And then the reality is it's not that easy. You have to know where to go, right? And a lot of the better auctions out there for return are live auctions, they're not online. And those are all things that we support. So we take care of the sale logistics, right? Give you the platform with analytics built in, so it tells you, right, here's you're going to likely get a better deal on this property, or should, right? It tells you the likelihood of that property making it to sale. Most things redeem, right? But there's some I guess the sexy term is AI, right? AI is just an algorithm. We have algorithms running in the background, basically analyzing all of our results data, saying we think this property is going to sell for X, and we think the likelihood of it going to sale is 33% or whatever. And those things can immensely help, investors, right? Folks that are doing this on a daily basis be more successful on a more regular basis. And so we put all that together into one package. Yeah.
Yeah, that makes a lot of sense. I mean, knowing where to spend your time as opposed to, chasing something that's likely never going to happen and ends up being a mailbox, kind of a situation. So no, that's awesome. If you were to, yeah, and I know you guys deal with, all sorts of different properties, but I'm just kind of curious if there's an average or kind of a sweet spot that you see for type of property, value of property, um, maybe even a territory. Is there, we've talked about different states and that. Are there some basic, um, key points that just as an overview of where you find the majority or, a better success opportunity lies?
Yeah, I guess I'll answer that in two parts. On the property type, right? I think there's a bunch of different models. Like there's if you're focusing on vacant land, I mean, there's areas where you find more vacant land. If you're focused on single family residential, there's more focus on that. Um, I mean, if I were to say there's a sweet spot, it would be a not where you most people want to be, meaning like if you see a property coming up in a sale and it is a $1 million property, it looks great, right? And the chance of that making it to sale are low, and the chance of that going to at any sort of decent discount are low. And so it's kind of an opposite. Don't target those would be my recommendation. Um, I think the folks that have been the most successful understand that and have embraced, I'll call the HGTV model. If you've watched any of those fix and flop. I don't know. There's a bunch of different, shows out there, but when they go into the house and it is just a wreck, right? Garbage everywhere. Looks like a hoarder lived there. Then I guarantee those are tax sale properties, or pretty darn to guaranteed, right? I've watched those shows in the past. And I'm like, I, how do I get in touch with these guys? Because I'm sure they're going to tax sales to buy these properties. That is what you can expect, right? And so you have to have a model that assumes that that's what you're going to get into. You're not buying in most cases, right? You're not buying a pristine grade A property in Beverly Hills that is going to be, make you $1 million day one. If that were the case, I wouldn't be talking to you. I would be taking full advantage of that scenario. And then if it ever dries up, then I would talk to you, right? So folks that have that unique model and how to deal with that, or have here's what I do with vacant land, or here's what I do with industrial, they're the ones that are more successful. On the location piece of it, I don't want to say where there are certainly sweet spots, and that's part of what of our program provides is helping guide people to some of those sweet spots. And so I don't necessarily want to give that away because I don't want to necessarily, create competition for the folks that are utilizing our program. But in general, the one thing I'll say is the less accessible a sale is, typically the better deal you're going to get, meaning like online auctions that are available to everybody worldwide. Yeah, you're going to have thousands of buyers and bidders on that versus a small, live auction in the middle of nowhere in a small, in a sparsely populated state. You're going to get a lot better deal, right? I think that's pretty obvious though. And then there's happy mediums where you can be somewhat close to a population center, get a decent deal on a decent house, and that's where our analytics come in.
Got it. And as far as the average hold time from acquisition to sale, is there any kind of an average time you see that it takes to turn?
On the deed side, it does vary based on the state. And to give you two examples, Georgia, the redemption period, you're buying a deed, but it comes with a redemption period. It's maybe I shouldn't have picked that example because it's a weird in the middle between a tax lien and a tax deed, what we call a redeemable deed. But it's a year and a day, right? Redemption period. And then you have to go through what's called a barment. Then you have to go through what's called a quiet title. And so you're 18 months before you can sell that property, right? And that doesn't include any sort of remodel time. And so the cycle time on those is a little longer, right? Versus Texas on the other hand is a 6 month redemption period, right? And so you basically cut 12 months off of that cycle. That doesn't mean that you get better deals in Texas, right? Versus Georgia. You just got to account for that. And there's states like Florida where there's no redemption period, right? You have to go through what's called a title certification, but that's a 30 to 60-day process in most cases. And so you can cycle that. I will say as a fund, we've been averaging just over 9 months on that cycle time from purchase to disposition. And that's an average, right? There's some that's been a lot longer. There's some that's been a lot shorter.
Got it. Um, for the people that are using your tool and have access to your funds, Um, is there, I mean, I would assume if the funding is available and the deals make sense, is there anything, is there any kind of an average number of deals that people are doing, or is there because I was, a lot of times it's when there's the limited of funds, you're done. But if you're finding a willing partner that has funds, I would think that the more deals you find, the more deals you would do. Is that correlate or?
Yeah, that's accurate. I mean, it's not, we don't have unlimited funds on our
Sure.
end. And there, certainly have limitations on geographic coverage of live auctions that we can support. We don't have, thousands of people. I mean, we track about 9,000 auctions a year, right? And 1.5, 2 million properties a year that go through this process. And so we certainly don't have an organization to support everything. But in general, the folks that are participating, our profit share structures are put into what we call buying power tiers, right? So, the deposit that they make, right? Essentially, their skin in the game, you know, defines not only what their profit share is going to be, but how much buying power they have, right? And so, if people have $200,000 in buying power, they buy until they use that up, and then they got to sell one in order to free up, and then they can continue, right? And then similar for $500,000 or $1 million in buying power. And there's programs beyond that for very advanced folks that we've been working with for a long time. But the starter programs, right, from the beginning, we do limit to $1 million in buying power per person per entity.
Got it. Um, in the people that are investing or that are out, I guess your profit partners,
Hmm.
is there a like is there a recognized split? I mean, I'm assuming you guys they identify the property, get it for a price that makes sense. You fund it, but they've put money on deposit, if I understood right, which kind of equates to how much they're going to participate. Um, is there a return percentage that I'm just trying to figure out how it splits, because I'm assuming it's based on the delta between what the acquisition and whatever upgrade or rehab numbers and the sale price. Am I right on that, or is that
Yeah, the profit share split is truly a profit, like what I'll call true profit, right? Is like,
right?
all right, there's the acquisition price, and like you said, then there's a cost of capital, there's remodel costs, there's usually closing fees and resale, there's usually some code or ordinance violations that got to be taken care of along the way. All that is considered an expense, and that's all counted toward, you bought it for this plus expenses, right? And so if you sell it for more than that, it's that more than that is split, right? So for round numbers, right, if you bought a property for 50,000, right, and there's $25,000 of other expenses, so you're into it for 75, you sell it for 100, right? It's the 25,000 that is split. And then how that is split, like you said, varies based on what their deposit amount is. So it varies anywhere from 12% to 68%, I think is how our tiers are, and there's a few of them in the middle, but um, that'll define like how much of that 25 grand profit that you get, is defined by that deposit amount.
Got it. And for your investors who invest in the fund, is there any kind of an average rate of return that you've seen over time?
Well, the notes that we have right now are all at 18% we offer. Not to say that those couldn't change down the road, but right now that's the offering is a 2-year 18% paid out quarterly.
Got it. Got it. No, it's a fascinating model, and I've got various clients that participate in some sort of a um, version on on varying different levels of participation, whether they're the lender or the borrower or the investor kind of thing. But it's neat to hear about your tool and how you tie it all together, and just it makes sense. You got people that know what they're doing. Um, you've taken the risk out of it by being the buyer or the fund is buying the properties as opposed to having to chase people. I love that, and and the opportunity even for the investors. That's awesome.
Well, thank you. I'm usually
Yeah.
unbiased, but I agree with you.
No, it makes complete sense. Makes complete sense. Hey, Brian, if we could, I'd like to shift gears here for a second. As I mentioned earlier, by day I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if there's a way we can avoid the risk. When that's not an option, we look to see if there's a way we can minimize the risk. And if we're not able to avoid nor minimize, we like to see if we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. Could be your clients, investors, political, Fed rates, whatever market, whatever it is that you identify and consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I'm not necessarily looking for an insurance related answer. And so if you're willing, I'd like to ask you, Brian Seidensticker, what is the biggest risk?
um, I guess as far as buying tax deeds or the fund itself.
It's for you to
For me to
define.
interpret.
Yeah, yeah.
Well, I think it's from a tax sale properties, tax liens and taxis in general. The biggest risk is the underlying property value, right? That alone addresses is this lien am I gonna be able to make a return on this lien or this deed at the end of the day or not? And that is your number one risk, right? Is assuming that you can make ssure that your underwriting process addresses that, right? And that you can't eliminate it because things can happen, right? I've certainly seen and been involved in a property that was purchased, and then for whatever reason gets demoed or has a fire break out or whatever. What you thought that property value was, right, is no longer there, right? And so either your model has to address that loss, right, or you have to accommodate for that loss in value. And so for example, tax lien folks try to ensure that, okay, the loss in value from things that could happen like that, ultimately still, if I'm only into that property less than 5%, a lot of things can happen and you're still okay, right? In the worst case scenario. On the tax deed side, it's not that easy, right? A lot of things can happen, and all of a sudden you thought you're in a great position, and all of a sudden you're upside down. But managing that asset value, underlying asset value, is the number one risk by far.
Got it. Brian, where can listeners go if they'd like to learn more, connect with you?
Well, simple thing, go to our website. It's taxsaleresources.com. And check out the web. There's a lot of content on there that is open and free. Check out our blog. I interview different attorneys across the country and explaining exactly how different states work. And so if you want to learn more about the space, I would certainly recommend starting there. If you want to call us, you can certainly call. There's a real person on the other end if you want to call the number there. But and go to taxsaleresources.com.
Got it. Well, Brian Seidensticker, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Darren, I appreciate having me. Thank you very much.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.